Good morning and wake up to the Pension Challenge. This is a joint European Retirement Week event organized by Better Finance, represented here today by Aleksandra Mączyńska. Welcome, Aleksandra. Also organized by the European Banking Federation, represented here by Mijs. Wim, good to have you here. And also Insurance Europe is a co-organizer, and I'm Michaela Koller representing Insurance Europe. And we are very honored to be joined by Nolan, who is an associate research professor at Ireland's Economic and Social Research Institute. And a very warm welcome to you here this morning. Our idea here is to have a thought-provoking discussion on the role of financial literacy in boosting pension resilience. And it is maybe of interest. In Insurance Europe, we have done a pension survey. We organize this survey now on a regular basis. And we have asked more than 16,000 people in 16 different member states about, their pension plans. And it was quite interesting, and their level of preparedness. And it was quite interesting that we had 1/3 of the respondents saying that they were not saving for retirement, so 38%. By the way, more women, 42% of the female respondents. And what we also saw that there is one reason that they give for not saving, that is by 14%, is that they simply do not have enough information. So it will be really interesting now to see and listen to Anne, who will first kick off our discussion by summarizing a research paper that I think, Anne, you have co-authored on financial literacy as a determinant of financial protection in the older pre-retirement population in Ireland. And then following this, we will have a discussion from the different angles, the kickoff by Anne from an academic perspective, then Aleksandra's immediate reaction from the consumer perspective, and Wim and I will come in from the banking, respectively, insurance perspective. So Anne, I would suggest you give us the introduction, and the floor is yours.
Excuse me. Thank you very much, Michaela. And it's a real pleasure to be here with you all this morning. And really thank you for the invitation to tell you a little bit about this research that I've done with my colleague, Karina Doherty at the ESRI. So just to give you a bit of background on this research on financial literacy in the older population, it formed part of a wider programme of research that we had carried out in partnership with the Pensions Authority in Ireland, who are the sort of statutory regulator for supplementary pension schemes in Ireland. And they were interested in, some of the issues, I think, Michaela, that you mentioned there around take-up and adequacy of pension coverage across the population. So I suppose the main motivation for this piece of research was that, as we're all living longer, we increasingly have to take responsibility for our own financial well-being in older age. We know, for example, that defined benefit pensions are now increasingly a thing of the past, and people are moving now towards defined contribution pensions, which are much more complex to manage in older age. People have to think about how they're going to use those resources and sustain that resource, I suppose, for their remaining lifespan. And then there's just more and more complex financial products that people have to worry about. And in Ireland, as in lots of other countries, there are concerns over pension coverage and also about pension adequacy. And there's obviously lots of different potential policy levers that you can use to influence those outcomes. But what I'm going to focus on today, I suppose, is one particular one, which I suppose is the focus of this morning's talk, which is financial literacy and financial education more broadly. So what we set out to do in this piece of research was to answer two questions. So first of all, we wanted to see how financial literacy, which, by definition, I'm talking here about sort of knowledge of financial concepts, the ability to do sort of relatively simple financial calculations, how that varies across the population. We had actually no evidence on that in Ireland before we did this research. And then secondly, we wanted to look at the link between financial literacy and various outcomes associated with sort of financial well-being in older age. And we wanted to focus on people who were approaching retirement, so aged 50 to 64, 65 in Ireland, depending on what the state pension age was at the time. So to do this, we use data from TILDA, which is the Irish Longitudinal Study on Aging. For those of you that are familiar with SHARE, the Survey of Health, Aging and Retirement in Europe, it's a sister study, follows very much the same format as SHARE. So it's a nationally representative survey of people over the age of 50 in Ireland that's been collecting data every 2 years since 2010. So we've got a really rich sort of characterization, not only of people's financial situation, their household composition, but also other outcomes that are important and characteristics like their employment history. So in one of the waves of the survey, so in 2014, participants were asked 3 questions that got at their sort of level of financial literacy. 2 of the questions were sort of very much probably more numeracy type questions, so around knowledge of fractions and percentages. And then there was a 3rd question around a compound interest calculation. And not surprising, this is the one that people found most difficult. So of the people that we surveyed who were on average age 61, we found that the average score, so out of 3, was 1.8 and the median was 2. But overall, only about 16% of people got all 3 questions correct. So really, quite concerning levels of financial literacy across that population. And on that compound interest question, what was interesting was that of the people who got it incorrect, which was the vast majority, about 2/3 of them answered as if it was a simple interest calculation. So, people weren't getting that sort of next step in terms of the compounding issue. And when we think about pensions and starting pension preparation early, knowledge of compounding is a key sort of cognitive concept that we need to understand to be able to be, I suppose, incentivized to invest in pensions and start saving early. Not surprisingly, these patterns varied by different characteristics. Michaela has mentioned the sort of gender gap in pension coverage. We also noticed a really significant gender gap in financial literacy, men scoring significantly higher than women. And there were also some variations by age and then socioeconomic status. So people with higher levels of education had higher financial literacy scores. So the next part of the analysis then was looking at how levels of financial literacy were associated with various different outcomes that you could sort of reckon would be sort of, financial well-being in older age. So we looked at 3 sets of outcomes. The first was occupational and private pension coverage. So here we just looked at whether or not you were paying into a scheme. We didn't look at the adequacy. We didn't calculate, I suppose, the replacement rate, for example, that you might get. Then we looked at various different indicators of wealth. So we looked at things like savings, stocks and shares, investment property, your own residential property, and then sort of other assets like things like land and jewelry and art. And then finally, we looked at an indicator of sort of financial strain. And what we found was that there was relatively little association between financial literacy and supplementary pension coverage. A little bit of an association with occupational pension coverage, but it was a very weak association. So overall, not much of an association. There was a stronger association, though, with wealth, particularly with total wealth and with investment property wealth. And that was strong and significant, no matter, have we changed definitions of wealth or did the usual robustness checks that, economists tend to do. And finally, there was a really strong association then with financial strain. So people who had higher levels of financial literacy reported less financial strain, so sort of less worry about their finances in the period before retirement. I want to leave, I suppose, some space at the end, and I suppose for sort of wider discussion. But I will sort of flag as maybe a couple of kind of policy implications, and I think these are probably worth us discussing, as a panel, in a little bit more detail throughout this morning's session. So I suppose the first one that struck us and that really is important in terms of policy is the gender gap. As Michaela mentioned, the gender gap in pensions coverage and adequacy has been well documented. we see here, obviously, a strong and significant gender gap favoring men in terms of financial literacy. Now, there's obviously lots of different explanations that have been put forward for that gender gap, and the different explanations potentially require different interventions. One explanation that's been put forward is that within a couple, men and women take on different roles, and maybe traditionally the male partner has taken on the sort of financial management in the household, and this has increased their financial literacy skills, whereas the woman has taken on more of the sort of household family tasks. But that is obviously changing in younger and sort of later generations of couples. There's other reasons, such as differences in perceptions of ability and sort of maths and numeracy between men and women, and also then in sort of things around the degree to which boys and girls at a very young age are socialized in terms of financial matters. There's some research, really fascinating research, for example, that boys get pocket money much earlier than girls, and this develops their skills at an earlier age. So really interesting sort of implications there, I think, for early intervention. So going back much earlier than the retirement population or pre-retirement population that I'm thinking about here. And I suppose just one thing on the gender gap, we do notice it in Ireland at younger ages as well. So I might come back to that. And then the second thing, so I'm running out of time here, but the second sort of policy intervention I wanted to bring up, or policy implication, is around, I suppose, the effectiveness and also the timing of financial literacy interventions. So I suppose one thing that came out of our research was that if you think about sort of pension coverage and whether people invest in supplementary pension cover, there was relatively little role for financial literacy. It wasn't a really important determinant at sort of that stage of life after the age of 50. So I think that points to two potential issues. One is do financial literacy interventions work? If we were to invest in those, and I think the evidence is can be pretty inconclusive. And secondly, then what's the best? When is the best time, I suppose, to intervene in terms of increasing financial literacy? And I suppose going back to some of the research I mentioned in terms of boys and girls and earlier ages, I would argue that we should be intervening much earlier in life. That essentially at the age of 50, it's too late to be thinking about this as a sort of a main driver of increasing your pension coverage. Other interventions might be more cost effective and more worthwhile. So I will leave it there and give plenty of time then for the rest of the panel to discuss these issues. So thank you very much for the invitation.
Well, thanks a lot, Anne. Very thought-provoking and interesting, and in a way also concerning, of course, if we see, the weak link or a certain inconclusiveness between, promoting financial literacy and then the ultimate outcome for private pension savings. Well, if I now turn maybe in a first step to the panel, I think all three organizations looking at now, Better Finance, the European Banking Federation, and also Insurance Europe, all our organizations have consistently and for a long time promoted financial literacy and education. So what is your reaction now to these research findings? Maybe, Aleksandra, I get started with you.
Thank you very much, and welcome to everybody. Thank you to Insurance Europe for inviting Better Finance to this panel. Just maybe a short word of explanation to participants who are maybe not familiar with Better Finance. We are an EU-level NGO that is representing the interests of financial services users, including investors, pension savers. To us, those findings are definitely interesting, maybe not that much surprising. We have been for a long time been a staunch supporter of financial education, but in fact, we have been always underlining that we have to start with financial education at a very, very early age. And we think primary school is actually really the timing and the moment where all the financial, like basic financial mathematics should be introduced, but also, for example, basic knowledge about capital markets. So starting early, definitely, doing this around being close to retirement age is definitely too late. But also when you think about really the moments of having the access to financial education during your adult life, they're really limited. That's what we've been also saying. And the two moments when you have the access to it and you can do it, it's at the point of sale and also as being an employee. And therefore we have also promoted and advocated for promoting and raising awareness about the employee share ownership plans, because we think it's a very good tool really to raise awareness about different financial concepts to adults. Another issue is that we have also pleaded for a long time to really have a proper evaluation of financial education initiatives, because there have been very many of them. And what is sometimes quite often actually lacking is the idea and the knowledge about what has really worked and what has not worked, and what was really the outcome and the impact of on the financial situation of individual citizens, financial services users who have been taking part in such initiatives. The third point that is extremely important for us is the independence of such initiatives. So we think they should be either supervised or carried out by independent providers, or at least supervised by public authorities, so that there is also for the financial services users this awareness and confidence that they are taking part in really financial education initiatives and not some kind of promotional campaigns of different products. And when it comes to financial education for adults, we think what is really important, what should be raised and put prominently in any initiatives focusing on financial education, is actually the drawing attention to the value for money that people are getting when buying financial products, and really raising awareness about costs and charges and how it impacts the returns that people are getting in the end. Because we can really invite people to start saving for retirement extremely early, but if the negative provided to them are going to be very low or negative, it's not going to help them very much during their retirement. And just a final remark, and maybe we can discuss it a bit later, because we have been always saying that financial education is just complementary action. And actually what people really need, because saving, investing, it's not a full-time job, it's really access to very good independent advice. So maybe this as a just start to the discussion. Thank you.
Thank you very much, Aleksandra. I think you are kicking us off nicely. Wim, do you agree? And maybe can we have your thoughts now?
Well, I always agree, of course. No, but thank you very much, Michaela. What is very important, thank you very much, Anne, for doing these important studies, because this is where it all starts. We need data. We need data to have the right tools to deal with financial education. And if you think that this morning we have a 30 to maximum 45 minutes starting seminar, I would say 30 minutes. That would be 6 times as much as people spend yearly on their retirement provision. So just think about that. And so there are many things that specifically for retirement provision that are so important. The first is people do not spend enough time on it. Secondly, people find it very hard, and I am exactly as any other people, to make really long-term decisions, because you're making decisions with 30, 40 years ahead. And that's hard. That's things change. But the first and foremost, and that's what Aleksandra also said, is you need the tools. You need the basic literacy, and you need the tools to understand what you're deciding. And indeed, as Anne also thought, there is 35% of men and 30% of women have basic understanding. So you see that there's a low basic understanding on one hand. Secondly, you see that there's a gender gap as well. And it's very important to close that gender gap, because you need the understanding not only to deal with your own retirement, but also to have what they call financial health throughout your life, to make the right decisions. And indeed, as Aleksandra said, primary and secondary school are very important to get that basic understanding. And it's also in the OECD's PISA criteria that financial literacy is important. But in later life, when there are life events, people also need to have the tools. This is, I think, where the industry comes in. I think that the industry could develop the tools to better understand and help people understand what they're deciding when. Because it's also for the industry, for the banking industry that I represent, it's important that people make the right decisions. And lastly, it is also important in Europe for our recovery and also for the move to a more sustainable economy, that people have the basic understanding. Because if people start investing in, I would say, green investments, people need to understand what they're investing in, especially long term. And finally, and this was also said, the beauty, but also the complexity of financial education is that there is no one size fits all, because indeed children at a certain age need different things. Young adults, entrepreneurs, people who get married, who have children. So you need to have tailored financial education. But it all starts with the basic needs, and that is what we need to work on all together.
Thanks, Wim. Couldn't agree more, certainly on also the working together part. Maybe a quick take also from Insurance Europe. I think our view would be it's really a two-step approach in the end. You need financial education and literacy as the foundation. It's the basis to everything. It's a little bit like, when you talk to people about a healthy work style, or, talk about diets, you first need the realization dawning on you. But then in a second step, we also need to ensure that we have the right tools and frameworks in place. I mean, Aleksandra, you mentioned a couple of them. You highlighted the value for money aspects, independent advice. For me, it starts even earlier. I think when it comes to pension, we shouldn't underestimate there's always the issue of nudging through financial incentives, taxation, but then also nudging, to bring nudging in with behavioral economics. For example, we know from the occupational pension area that automatic enrollment plays really an important role. Product design, we can help people through default option, trying to develop simpler products. We have now an attempt with the PEP, the Pan-European Pension Product, which we have to wait and see how that plays out, because there were high hopes, but then through the whole development at legislative level, we have seen a lot of developments. Let's see how that pans out. We also need to look at, new approaches, because we also need, and we know, Anne said very clearly, there is a challenge, to make people start early, because this compound interest understanding is not yet there. So obviously, the earlier we go in, the better. There are now very interesting approaches, saving through spending approaches, new apps, credit cards that, offer cashbacks directly invested into pension funds. We need to use that much more. But then there's also, of course, the role of regulation. We should not come to a point where we go to an information overload, because that scares people off if they have too much and they don't see the wood for the tree. We need to make information easy to access. Help work with public authorities on pension tracking. They are very interesting. In your own seminar, Aleksandra, you had the orange envelope example from that Jan Sebo has presented from Slovakia, but also in Sweden they have an orange envelope concept. So I think it's these different elements that we need to bring together. If I can say one last point, the value for money, cost and charges, I fully see that. I'm sometimes worried, especially when I look at it from an insurance perspective, that we have too exclusive focus on cost and charges, and sometimes we underestimate the role of safety and security that is especially important in pension, and the fact that if you provide safety and security, we don't really have the space currently in current regulation to highlight these benefits sufficient, or to make clear that these benefits are maybe not offered throughout the whole value chain by all providers. So also a little bit of food for thought, I think, for the regulatory side, because in the end, it's like pieces of a puzzle. It all plays together, I think. But maybe I want to pick up also on what you said, Wim, do we need new approaches? And that would be my next question to both of you. what can we do better? Where can we really try to make a change? Aleksandra, can I turn to you again?
Sure. I think that what is really important is really right now to take into account also by the policymakers to take into account really the results of the behavioral studies. We have discussed this recently to a certain extent in a disclosure workshop with EIOPA, because from this workshop it was also very clear that simplicity really helps financial services users and investors. And the simpler the information in the disclosure documents, the more it boosts really the understanding and also the will really to act on it. Then definitely the really early age to start with financial education, and also to use, I mean, there are so many different, very interactive, interesting tools to make this basic financial mathematics, you know, investing, talking really about pocket money, how you can also as a child use this money, maybe invest it, maybe save a bit to have a bit more in the future. There are really many interesting tools to even make it really very understanding to children how compounding really works. And I think you can already do it at the very early age. So in terms of financial education, we can really do a lot more than we are doing. And we should also really start with evaluation. So really evaluate some initiatives that have been already carried out and maybe have some really good best practices or lessons learned that should be shared. But then, as I said, we really think that financial education is complementary to some other actions. And I would very much agree with what you said, Michaela, that there is really a lot of room for improvement for policymakers, because when it comes to saving for retirement, you can really do a lot, as you said, with some financial incentives and nudging, taxation. So there can be done a lot there. Promotion of PEP and making it really feasible and possible to invest in PEPs. Then when it comes, as you said, we think also that within financial education, you should really make it also very clear to investors, to financial services users, they have to understand the risk. You mentioned the safety. There are different products that can be suitable for their needs. They have to understand their risk profile. They want to understand their appetite for risk. But they also need to understand very important two dimension of risk that sometimes even the policymakers forget about. And this is the probability of risk and the magnitude of risk. And this is really important for the financial services users, and they really need to understand that. And then when it comes to gender gap, I think there is also possibilities to act on that. And we know it as well from Better Finance national member organizations, because some of them actually found out that if you do financial services or investing trainings just for women, all of a sudden you have a much higher turnout at such workshops or seminars. Women are much more engaging into the discussion. So maybe this is also something we should consider, but it would be also very interesting to learn from maybe behavioral studies why at some point in life it comes to that, because we have co-educational systems. So we learn to a certain extent through our lives together. And at some point then when it comes to financial services, it's easier for women to act and interact with women and in women-only environments. So it would be also interesting to learn, why it's happening like that and why this women-only environment is at some point helpful.
Interesting. I hadn't heard about that. I don't know about you, Wim, but what is your take on it?
No, to react on Aleksandra, I have heard about it. I have heard about that, and it's indeed true. So as I said in my earlier answer, the gender gap is very important, and there's also important research done by Professor Anna Maria Lusardi on exactly the gender gap. And indeed, if you look at the sociological environment, if you have groups of women together, they are more open to the discussion, and that there are all sorts of sociological. I'm not a sociologist, so I can't really understand where it comes from, but there is no doubt, and there's clear research that this works, and it's something that we should follow up on, because indeed the gender gap, especially with equality on the work floor, is very important, and it is very important because it also leads to independence for all people, independence of women, that they have the same knowledge. Now, certainly already in these 30 minutes, our knowledge on financial education, just talking about it, has enriched a lot. And part of the problem is and if I speak for myself, for instance, of the knowledge of pensions is, as I said, it's the long term of the decision, but also the collective pension systems. Because, of course, in Western Europe, we have been blessed by collective pension systems, but that also has led to less need or less knowledge. And many people are surprised that when they get 65 or now 67, that the collective pension system delivers less than they originally thought it would. So that makes it very important. So this knowledge in itself, the fact that we get older and that there's more of us, makes it important. First, the awareness that you need to save next to your collective pension. You will always do that. Now then, the second part we have already discussed and is also important is we need more research and more data, because then we can decide on the basis of that data and research what kind of new approaches we can use. And then, indeed, financial education is something of a life cycle, a lifelong learning, because indeed, I already mentioned the PISA criteria of the OECD that are so important that you start in primary and secondary education with the basics. Then, indeed, we can do a lot as regulators, but also the industry in developing tools for the teachers, but also tools for people who have to decide in certain live events. So awareness and tools. And finally, very important is information. And Michaela, you mentioned it yourself already, the importance of data vaults for pensions, because indeed many of the collective pension systems were based on the premise that you would stay in one job for 30 years still. And of course, people change. That means that the information and the amount of money are all over the place, and people need that transparent information. And in many countries, they have taken new approaches to these data vaults. So in short, basic education and schooling, tools during live events, and finally, clear and transparent information through data vaults. That's what we certainly need to work on.
Couldn't agree more. Could I add maybe one aspect that I think could also really help is, the increased use of digital tools. This is, I think, particularly now when we look at, I look at my children, they are starting their work life. If you want to get them, you need to really get them through the digital means. This is how they operate, how
Absolutely.
they work. And also our recent survey has shown, 72%, I think, would now already prefer to receive their information digital. Now, we have to pay attention that we are not losing those that are not digital literate. And there must obviously be tools to still cater for them, but we are a little bit slow with the digital uptake, and probably there also, more progress could be made.
Yeah, but you're absolutely right, because indeed, when I talk about tools, and you see that I think of the opportunities that the digital world gives us, but indeed, then by not letting those who are not digital behind, you already mentioned, for instance, the importance of connecting financial education to digital skills.
Absolutely. Aleksandra, digital on your end, any comments quickly before we go slowly but surely into our closing round?
Definitely. I mean, Better Finance is doing the annual research into the robo-advisors, because we also look at to what extent those kind of tools are really helpful also in saving for retirement, but in terms of financial education. And we see that those platforms are really trying to provide year to year more and more financial education tools, videos to really explain certain concepts. And actually those kind of platforms and tools are also quite important for promoting simplicity. And it was already one of the findings of the quite important study from 2019 from the Commission, that actually those platforms were the one channel on which individual investors and savers could find simple products. Because this would be something else that for me is extremely important, to promote more simplicity in financial services. And here I see also a lot of room for improvement also for the policymakers and supervisors.
Yeah, simplicity. I was, I'm always thinking then about the journey also we had when we had this discussion around PEP, where we also were hoping to get a simple product, which hasn't quite worked out this way. It's maybe also owed to the legislative process. I don't know. But of course, simplicity is always a buzzword, Wim. We are dealing with increased complexity in the financial landscape. Your take on it?
Well, Michaela, indeed, and you and I have stood shoulder and shoulder against complexity sometimes, but some products, and especially if you have live products, long-term investment products, they have a complex side to them. And this is something we need to recognize. Having said that, I always have to smile with all the attempts, indeed, you mentioned the regulator, to cram all that information in one piece of paper, because the legislator sometimes asks to be concise and simple. And I have been for almost 30 years in financial services, but if I read one of these indicator texts for some complex product, I usually get totally confused myself. So indeed, it comes from two ways. At first, I do believe that it is up to the industry, the providers of financial services, to be as understandable as possible and as transparent as possible in the products that they sell. Having said that, it is inevitable that some long-term investment products have a complex side to it, and that is where financial education comes in, because that's why you need the basic understanding. So I am a big believer, for instance, in the OECD EC framework on financial education, because I think that can really help understand the basics. And you don't want people to fully understand, but you want people to be able to ask the right questions and get it explained. Now, one of the themes, and we also all worked closely together on the European Money Week next week, is exactly on this supercharge. We call it the theme supercharging our financial education, and it will exactly go into that. How can you help with the level of education needed to ask the right questions on complex products? And there is a lot of research. There is the BBVA Center for Financial Education that looks at the way in which digitization can help to unbundle some of the complex products, but also indeed in sustainable, because you hear a lot about green investments. So all in all, it needs to come from two sides. First, clear and transparent information, and a lot of the industry is working on that. The recognition that some products are complex, and then on the other side, a basic financial education. So it is a two-way street, if I may.
Yeah, and adding to that, I want to pick up on what Aleksandra said. You highlighted really the need for transparency on pricing, to really make competition work. And I think we can all agree that is, certainly the basis that could really make also a pension discussion, easier ultimately. For me, also, one thought you have mentioned earlier, Aleksandra, value for money, if I can pick up on that. There is really now a good engagement, I think, on the topic. Where I'm sometimes a little bit worried is that we are also going too much into a corset, and are not taking enough account of the fact that we have very different situations, very different people with different needs. And if we are too rigid in this approach, this one size fits all in the end doesn't really matter. And Wim, to your point on these standardized comparative tables, that I must honestly also say I would prefer not to read them. And sometimes we had this thing, you have to do and provide information in 3 pages, and the end result is that the font size gets smaller, and still, you don't sometimes see the wood for the tree. So all these elements need to be addressed. And I would now take the opportunity to turn back to Anne. You have the not enviable task, or I ask you at least the question, if you would now, also following this short exchange, have to give a policy recommendation, to increase financial literacy, to make it better, what would be your take on it?
Thank you, Michaela. So that's a really broad question and a really difficult one to answer. But I suppose can I make two, I suppose, and it's reflecting on that really fascinating discussion. And I think it's taking up, in the first instance, it's taking up, I think, one of the points that both Aleksandra and Wim made around, number one, sort of simplicity in information, but also, I suppose, the call for more data. And I think you can merge those with pre-testing of interventions. So I think both panelists mentioned as well the role of behavioural science. So at the ESRI, we have a behavioural research unit. And actually, as part of that project that I gave you the results of for the Pensions Authority, the Pensions Authority actually were really interested in trying to improve their communications. So as Wim mentioned, you get this long pension statement, the font is tiny, all of the sort of standardized information is there because it has to satisfy the regulator, but it's completely incomprehensible. And it's not provided in a way that's comprehensible and understandable to individuals. So what they did actually was to pre-test sort of different forms of communication, randomize them across the sample, and came up with what was the most effective then in terms of encouraging people to invest more in pensions. And they found actually that sort of visual presentation of information was actually quite effective, as opposed to sort of the very sort of standard sort of numeric tables that you would see. So as one simple example was, for example, just showing a sort of like a pot and saying, if you invest X more, per month or per annual, this is what your pension looks like, in 10 years, in 20 years, in 40 years. And actually just showing a sort of a pot getting bigger was actually really effective, as opposed to a sort of a table. So I think, it's that sort of pre-testing of interventions. We don't know the answers here, but we have the tools to be able to pre-test policy interventions and to come up with sort of a better design of some of these information things. Secondly, then it's taking up the sort of the gender gap and the early intervention piece. Absolutely, completely agree with Aleksandra and Wim about early intervention here. And I think it's broader than financial literacy. It's also around sort of more general numeracy skills. And I think, there's Wim mentioned a sort of a sociological piece here. Some of my colleagues have done some work using a sort of a sister study to Tilda, which is the Growing Up in Ireland study, which is of two cohorts of young people. And actually, they found really interesting differences in how both teachers and parents perceive mathematics ability on the part of the children between boys and girls. So not only, you might expect that, parents, may perceive their boys or their sons to have higher mathematical ability than their daughters, because there's that sort of unconscious bias that's been built up, through generations. But actually teachers perceived boys to have better mathematics ability than girls, even though, there was no difference objectively in their ability. So there's a much wider piece, I think, in terms of unconscious bias that needs to be done. So that's a wider sort of policy intervention in terms of education. And then finally, I think the sort of the confidence bit between men and women in their perceptions, I suppose, of their ability is really important. Wim and Aleksandra both mentioned, attendance at events is much higher when it's sort of female only as opposed to mixed. We see that coming through in our data as well. Women are much more likely to say they don't know to answer, questions, whereas men are much more likely to make a stab at an answer, even if it's going to be incorrect. So, again, it goes back to early socialization. There's this sort of these long-standing sort of gender stereotypes and unconscious bias that gets built up through the generation. So a really difficult one to solve. But I think, again, early intervention, starting as early as possible, is the message here.
Well, thank you very much. Simplicity, more data, pre-testing, visuals. I like this, for me, this really also speaks to myself when I look at information. A visual often, helps more than 1,000 words. The unconscious bias, which will be interesting also the more we move forward, when you see so much unconscious bias now in the world, and then you move to an AI world, how will this have to be addressed, the confidence level. There's really much food for thought. I give now 2 short closing remarks to Aleksandra and Wim, and then I'm afraid we have to close this very interesting session. So Aleksandra, maybe first to you.
One maybe first comment to complex products and the fact that one size doesn't fit all, and I would agree with that. The difference that I see maybe when it comes to the views, the difference of views between me and Wim is when it comes to more complex products, I would see more role really for independent financial investment advice, because I think that basic financial knowledge, then it's not enough. If there are complex products, I think also some behavioral studies prove that basic financial knowledge does not help then investors to take a good informed decision, because they are really not wired to understand those complex products. And when it comes to boosting financial literacy levels, and especially the gender gap that we mentioned, I think that maybe for a start, we should really then focus and enable women to really learn and test in this women-only environment, because they find it for some reason safer.
My short remark is indeed, I think that the European Retirement Week is already a success in all of us talking, because you get so much further by exchanging thoughts and best practices, by realizing that there is a pension gap, by realizing that there is a gender gap, and then rallying people around it, creating an ecosystem in which we exchange. So for me, already this panel, even though it was short, is for me very important. Then on indeed the complexity of products, indeed this is something that we need to continue to talk, because I do agree that you cannot let people sit alone behind their desk at home trying to find out, even with help of the internet. People need to have the not only the basic skills, but also sometimes the explanation, and so I understand very much the importance of advice this. Now then, finally, on no one size fits all. Indeed, we need a rich, we need to talk about financial health, and in that financial health, we need a rich mix that consists of education, tools, but also ways of addressing different groups, ways of addressing disadvantaged groups through financial inclusion, the younger people who are at life events, but then finally with women, because indeed the level of confidence, I realize now that this was also Professor Lusardi who did research in the level of confidence, just that. And I would like to end with a very strong image that she has towards the interest in financial education. She always mentions the little girl in front of the angry bull in front of the stock exchange in New York. And she says, let's all be that brave little girl. And I would like to think that is the perfect image for continuing to discuss.
Well, then I think I have nothing more to add, Wim, because that is, in fact, a very strong image. And I think also one that gives hope. And as you said, it was a great morning to discuss with all of you. I hope we can continue the discussion. Thank you, Anne, for giving us so much food for thought. Thank you, Aleksandra and Wim, for this open exchange. And to the audience, I hope you have enjoyed this kickoff discussion, and thank you for watching. Thank you and goodbye.